Here's every hawkish statement from Federal Reserve Chairman Powell's meeting in under 3 minutes. First up was the CPI report, which popped the market up, and then Powell's speech for the roller coaster ride straight down. Let's get into his speech.
Today, the FOMC raised our policy interest rate by a half percentage point. Though we have more work to do. Continue to anticipate that ongoing increases will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. We're continuing the process of significantly reducing the size of our balance sheet. Despite the slowdown in growth, the labor market remains extremely tight, with the unemployment rate near a 50-year low. The labor market continues to be out of balance, with demand substantially exceeding the supply of available workers. Inflation remains well above our longer-run goal of 2%. In November, the 12-month change in the CPI was 7.1%, and the change in the core CPI was 6%. It will take substantially more evidence to give confidence that inflation is on a sustained downward path. Participants continue to see risks to inflation as weighted to the upside. The longer the current bout of high inflation continues, the greater the chance that expectations of higher inflation will become entrenched. And we are strongly committed to returning inflation to our 2% objective. And we are continuing the process of significantly reducing the size of our balance sheet. As shown in the SEP, the median projection for the appropriate level of the federal funds rate is 5.1% at the end of next year, a half percentage point higher than projected in September. Reducing inflation is likely to require a sustained period of below-trend growth and some softening of labor market conditions. The historical record cautions strongly against prematurely loosening policy. We will stay the course until the job is done. Sufficiently restrictive policy stance yet, which is why we say that we would expect that ongoing hikes would be appropriate. You will also know that at each subsequent SEP during the course of this year, we've actually increased our estimate of what that peak rate will be. FOMC participants believe that inflation risks are to the upside, so policy is restrictive enough. I've told you today we have an assessment that we're not at a restrictive enough stance, even with today's move. We've continually expected to make faster progress on inflation than we have, having to tighten policy more. And so it didn't go up by much in the meeting, I don't think, but that's the idea, is slower progress on inflation, tighter policy, probably higher rates, probably held for longer, just to get to where the kind of restriction that you need to get inflation down to 2%. And we're going into next year with higher inflation than we had thought. Estimates, wages are running, well above what would be consistent with 2% inflation. My view and my colleagues' view is that this will take some time. We'll have to hold policy at a restrictive level for a sustained period. Changing our inflation goal is just something we're not thinking about. It's not something we're not going to think about. We have a 2% inflation goal, and we'll use our tools to get inflation back to 2%.